Welcome back to the show, Sam. It has been an absolutely wild ride for housing markets across Canada, and I know our listeners are trying to make sense of all the mixed signals. One week they see doom and gloom, the next week they hear about record highs somewhere. What is the single biggest story you are seeing this week, and how should people interpret it?
Thanks, Lisa. The biggest story is that Canada is really two different housing markets pretending to be one country. The national numbers look scary because the composite index shows #4. Zero prices are down 21.3% from the peak, but that decline is almost entirely due to Ontario and British Columbia. If you live anywhere else, the correction hardly shows up at all. In fact, only two provinces are at record highs right now, Newfoundland and Prince Edward Island, which tells you how lopsided this really is. So when people ask me if we're in a housing crisis, I tell them it depends entirely on which province they're standing in.
That is such an important framing because the headlines can make it seem like the whole country is crashing. So for someone living in the GTA, this correction is very real. Could you give us a sense of how much prices have actually fallen here? And what is driving the sharpest monthly drop we saw this summer? I want to dig into something you said earlier. You mentioned that only two provinces are still at record highs. Which ones and why are they doing so well?
Great question. The two standouts are Newfoundland and Prince Edward Island. While the national composite has fallen sharply, #2.0, only Newfoundland and Prince Edward Island are at record highs. This shows that the correction is not a uniform national event. It's really a story of overheated markets like Ontario and B.C. cooling down, while smaller provinces are seeing sustained demand from people seeking affordability and lifestyle changes.
That makes a lot of sense. So how does that translate into the daily reality in the GTA? I know many of our viewers are wondering if their home value is at risk or if they should wait before buying.
Absolutely. In the GTA, the typical home price saw its sharpest monthly drop this year in July, which really caught a lot of people off guard. We saw #20.0, the typical home price slipped 0.6% in July, bringing the average down to $661,800. That might sound small, but it is the steepest month-over-month decline we have seen since December, and it reflects growing hesitation on the buyer side. At the same time, the pace of price declines is not uniform across different property types, and that is something we need to look at carefully.
Yes, I think our viewers would love to understand that. Are condos being hit harder than freehold homes, or is it the other way around? Let's break down the price history that we have for all these different property types so people can see where their segment stands.
Happy to do that. Let's start with condos, because they are definitely taking the brunt of the correction. A typical one-bedroom condo is now trading around $467,000 compared to $522,000 a year ago. Two-bedroom condos have fallen from $622,000 to $582,000 over the same period, and even three-bedroom units have dropped from $620,000 to $601,000. So we are seeing a significant price reset in the condo segment, especially at the entry level.
Those are really big moves, especially for people who bought at the peak. What about freehold townhomes and detached homes? Are they following the same pattern, or are they holding up better?
Freehold townhomes are softer but not as dramatic. A three-bedroom freehold townhome is now around $702,000, down from $751,000 a year ago. Four-bedroom townhomes have eased from $920,000 to $870,000. Detached homes are actually the most resilient, particularly at the entry level. The two-bedroom detached segment is sitting at $585,000, just a hair below the $589,000 we saw a month ago. Three-bedroom detached homes are at $740,000, barely moved from $745,000 3 months ago. The higher end, like five-bedroom detached homes, has given back more, going from $1.33 million to $1.28 million. But the overall picture is that the lower price points are holding up better.
So it seems like the market is rewarding more affordable property types. But even with those price drops, I bet the income required to buy is still sky high. What do the latest affordability numbers look like, and are they improving at all?
You're absolutely right. The affordability numbers are still daunting. According to the most recent analysis, #16.0, the required income is $236,780 to buy a typical GTA home. That is about 140% higher than the median household income in the region, which is why so many potential buyers are simply shut out. Even with the price declines, the monthly payment on a typical home consumes a huge share of a family's income, leaving very little room for anything else. So the correction has not actually solved the affordability crisis. It just made it a slightly smaller mountain to climb.
That is really important context. And you mentioned the Bank of Canada's own research earlier. I was reading that the bank itself is saying rate cuts might not help affordability. Can you explain that for our viewers?
Yes, it's one of the most underreported stories of the year. The bank's staff economist published a working paper that basically says #10 monetary policy seems unable to ease housing affordability pressures and might actually make them worse when the labor market is strong. Here's the mechanism. When rates are cut, demand for homes jumps almost instantly because borrowing costs go down. But the supply response takes a very long time, often up to 2 years, because builders need to get permits, secure financing, and actually construct units. So what happens is the rate cut creates a short-term demand surge that pushes prices higher before the new supply ever arrives. That is the opposite of what policymakers want to achieve.
That is a really uncomfortable truth for anyone hoping for a series of rate cuts. And then we got that inflation report this week. How does that complicate things further?
Inflation is definitely making the bank's life more difficult. July's consumer price index showed #17, zero CPI annual growth accelerate to 3%, which is exactly the upper limit of the bank's target range. And it's not just energy prices. Broad price pressures are actually accelerating across many categories. This means the bank cannot cut rates aggressively without risking an inflation flare-up. But if they hold rates high, the economy could slow further. It's a true catch-22, and it has direct consequences for the housing market because mortgage payments will not be getting much cheaper anytime soon.
Meanwhile, we're also seeing household debt climb to record levels. Is that a sign that people are really struggling to make ends meet?
It is a very clear warning sign. The latest data from the credit agency shows that #30 household debt reached $3.29 trillion in June, which is an increase of 4.3% compared to last year. The interesting twist is that mortgage debt growth is actually slowing, but consumer credit is growing much faster. In fact, non-mortgage consumer credit grew at one of the fastest rates in over 16 years. That tells me that people are using credit cards and personal lines of credit to cover their day-to-day expenses, not to buy big-ticket items.
What is your interpretation of that? Are people just being cautious, or is this a sign of real financial distress?
I would call it distress borrowing, and I am not the only one. Credit agencies like TransUnion are using exactly that language. #3.1. The trend is amplified by consumption smoothing or distress borrowing, according to their analysis. What that means is that households are borrowing to maintain their lifestyle even though their incomes are not keeping up with inflation. That is not a healthy dynamic, and it is especially worrying when you consider that many of these households also have large mortgage payments to make. I see this as a sign that the pandemic-era borrowing binge is now coming home to roost.
That makes sense. And with that kind of strain, are we seeing more people file for insolvency? I saw some reports about that.
Yes, the insolvency numbers are definitely elevated. June saw #13 insolvency filings climb to 13,254, making it the second highest June on record. That is up 11.5% from last year and more than double the volume we saw in 2020. While some economists try to downplay that by pointing to population growth, the absolute numbers are still very high. It suggests that a growing number of households are reaching the breaking point, even if the per capita rates are still below historical peaks.
Right, I heard BMO come out and say it's not a big deal. They said it's basically just returning to normal. Do you agree with that?
I understand the per capita argument, but I think it misses the bigger picture. BMO points out that #14 insolvencies have basically just normalized back to pre-pandemic conditions, which is true if you adjust for population growth. But the raw numbers are still the second highest June on record, and they represent real families in distress. Population growth creates more demand for housing, so it doesn't make the strain any less real. I see this as a sign that the credit industry is beginning to feel the pressure from overextended borrowers, and that is something worth watching closely in the months ahead.
There's also a striking report about younger Canadians' incomes compared to their parents' generation. How does that factor into the housing market?
That report really highlights a generational challenge. Statistics Canada found that #12 those aged 25 to 34 are earning about 7% less in real terms than their counterparts did in 1976. Meanwhile, seniors have seen their real incomes jump dramatically. So the generation that's supposed to be entering the housing market is actually earning less than the generation before them, adjusted for inflation. That makes it incredibly difficult to save for a down payment, especially in high-priced markets like Toronto. It also means the demand for housing from young buyers will remain constrained for years to come.
So with all this financial pressure, what's happening with mortgage renewals? Are a lot of people going to be forced to sell their homes?
That was a huge concern, but so far we are not seeing mass forced selling. A recent survey found that #5 71% of respondents say they are not considering moving to avoid higher mortgage costs. That suggests most homeowners plan to stay put and adjust their budgets rather than sell. They might cut back on discretionary spending, dip into savings, or even take on additional debt, but they are not putting their homes on the market. This is a sign of resilience, but it also means the inventory of homes for sale will not be getting a sudden boost from distressed sellers.
That is reassuring to hear. Let's talk about market balance. We've seen months of inventory numbers improve a bit. What does that tell us about the direction of prices?
The market is indeed moving toward balance. We saw #26 months of inventory fell to 4.7, which is actually the lowest reading of 2026 and a bit below the long-term average. That means the supply of homes for sale is being absorbed at a faster pace than it was a few months ago. However, it's still not a seller's market by any stretch. Buyer demand is steady but not strong, so we are likely to see a continuation of modest price declines in the near term, especially in the condo segment where inventory remains elevated.
Given all of that, what is your advice for someone who is thinking about buying a home in the GTA right now? And what would you say to a seller?
For buyers, I would say this is a market where you have the luxury of choice and time. Inventory is still elevated, and there is no urgency to rush into a purchase. Take time to find the right property, negotiate a fair price, and don't let the fear of missing out push you into a bad decision. At the same time, recognize that we are closer to the bottom than the top of this cycle, so if you find a home that fits your long-term goals, it is not a bad time to act. For sellers, the message is the opposite. You cannot be greedy. Pricing your home even a little too high will cause it to sit on the market and ultimately sell for less. In this environment, realistic pricing and strong presentation are critical to getting a deal done.
Sam, that is extremely practical advice. Thank you so much for walking us through all these complex issues with such clarity. We will put the key takeaways and relevant links in the description below. And if you have questions about your own situation, please don't hesitate to reach out to our team. Thanks for watching, and we'll see you next week.